Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share with your friends and family, and stay up to date to our future videos. The housing bubble refers to a phenomenon where housing prices rise rapidly due to high demand and speculation, leading to a market that is overvalued and unsustainable. This can ultimately result in a market crash, with housing prices plummeting and leading to widespread economic turmoil. The most recent housing bubble in the United States began in the early 2000s, fueled by loose lending standards, low interest rates, and a belief that housing prices would continue to rise indefinitely. The bubble burst in 2008, leading to a severe financial crisis and the Great Recession. The end of the housing bubble was marked by a number of factors. Rising interest rates made it more difficult for people to afford mortgage payments, leading to a decrease in demand for housing. The housing market became oversaturated, with too many houses on the market and not enough buyers. As a result, housing prices began to fall, leading to a decrease in home equity and an increase in foreclosures. The end of the housing bubble had significant repercussions for the economy as a whole. Many homeowners found themselves underwater on their mortgages, owing more on their homes than they were worth. This led to a wave of foreclosures and a decrease in consumer spending, which in turn had a negative impact on businesses and the job market. In response to the crisis, the U.S. government implemented a number of measures to try and stabilize the housing market and prevent further foreclosures. These included programs to help homeowners refinance their mortgages and stay in their homes, as well as efforts to stimulate the economy through government spending and tax cuts. The end of the housing bubble was a painful and difficult period for many Americans, but it ultimately led to important reforms and a renewed focus on responsible lending practices and financial regulation. In addition to the government measures, the housing market also saw a shift in buyer behavior. Many individuals became more cautious about taking on too much debt, and lenders became more strict in their lending practices, requiring higher credit scores and larger down payments. This helped to prevent another housing bubble from forming in the years following the crisis. Another key factor in the end of the housing bubble was the role of financial derivatives, particularly mortgage-backed securities. These complex financial instruments allowed banks to package together many mortgages into one security, which could then be sold to investors. While this initially provided a way for banks to make more money from mortgages, it also created a situation where the risk of default was spread out among many different investors. When housing prices began to fall and defaults increased, many of these securities became toxic assets that were difficult to sell. This in turn led to a liquidity crisis for many financial institutions and contributed to the overall economic turmoil of the Great Recession. In the aftermath of the housing bubble, there were many calls for increased regulation of financial derivatives and other complex financial instruments. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, included provisions aimed at increasing transparency and reducing risk in the financial system. The end of the housing bubble marked a turning point in the U.S. economy and financial system. While it was a painful and difficult period, it also led to important reforms and a renewed focus on responsible lending and financial regulation. The end of the housing bubble also had an impact on the broader housing market. After the crisis, there was a significant decrease in new housing construction, as well as a decrease in the number of people buying and selling homes. This led to a glut of existing homes on the market, as well as a decrease in the number of new homes being built. However, the housing market has recovered. Interest rates remain low, and there continues to be strong demand for housing in many parts of the country. In some areas, housing prices have surpassed their pre-crisis levels. Despite the recovery, there are still lingering effects of the housing bubble and subsequent financial crisis. Many people continue to struggle with high levels of debt and damaged credit, and the crisis led to significant economic inequality and job losses. It will be important to continue to monitor the housing market and to take steps to prevent another housing bubble from forming. This includes ensuring that lending practices are responsible and transparent, and that financial regulations are in place to prevent excessive risk-taking. The end of the housing bubble was a difficult and painful period for many Americans, but it also led to important reforms and a renewed focus on responsible lending and financial regulation. While there are still lingering effects of the crisis, the housing market has largely recovered, and there is hope for a more stable and sustainable future. One of the positive outcomes of the housing bubble and subsequent crisis was the increased awareness of the importance of financial literacy. Many individuals and families realized the need to better understand personal finance and investing, particularly in the context of the housing market. This led to a number of efforts to improve financial education, particularly for young people. Schools and colleges began offering more courses and programs focused on personal finance, and organizations such as the National Endowment for Financial Education and the Financial Industry Regulatory Authority (FINRA) launched educational initiatives aimed at improving financial literacy. The crisis led to increased public awareness of the importance of credit scores and the need to build and maintain good credit. Many people realized the impact that their credit score could have on their ability to obtain loans and other financial products, and became more focused on building and maintaining a strong credit history. The end of the housing bubble had far-reaching effects on the U.S. economy and financial system. While it was a difficult and painful period, it also led to important reforms and a renewed focus on responsible lending and financial regulation. The crisis also highlighted the need for greater financial literacy and education, and led to a number of efforts aimed at improving financial understanding and decision-making. The end of the housing bubble also had geopolitical implications, particularly in the global financial system. The crisis demonstrated the interconnectedness of the world's financial markets and the potential for a single event to trigger a widespread economic downturn. In the wake of the crisis, there was increased attention on global financial stability and the need for greater cooperation among international regulatory bodies. The G20, a group of the world's largest economies, began meeting to discuss financial and economic issues, and there was increased dialogue and collaboration among central banks and other financial institutions. The crisis also had a significant impact on the perception of the United States as a global economic leader. Many countries, particularly those in Europe, saw the crisis as a reflection of broader economic and political issues in the U.S. This led to increased scrutiny of U.S. economic policies and practices, and a reassessment of the role of the U.S. in the global financial system. In the years since the crisis, the U.S. has worked to rebuild its reputation as a global economic leader and has taken steps to address the underlying issues that led to the housing bubble and subsequent crisis. This includes a renewed focus on financial regulation, increased attention to financial education and literacy, and a commitment to working with other countries to promote global financial stability. Overall, the end of the housing bubble was a difficult and painful period in the U.S. economy and financial system, but it also led to important reforms and a renewed focus on responsible lending and financial regulation. The crisis highlighted the importance of financial literacy and education, and had significant geopolitical implications, particularly in the global financial system. While there are still lingering effects of the crisis, there is hope for a more stable and sustainable future.